Good afternoon, everyone, and welcome to our latest webinar. This one we're tackling today is the accommodation pricing review and what to expect in FY27. First off, though, we'd like to obviously always acknowledge the traditional custodians of country throughout Australia and their connections to land, sea, and community. We pay our respects to their elders, past and present, and extend that respect to all Aboriginal and Torres Strait Islander people today joining us. So they're looking at our agenda today. So as always, we will be diving into our poll results that we've sent out at the start of all of our webinars. And a bit of a different program today. So we haven't got any special guests. We just have the one special guest, Tyler, our head of data and insights, who's going to be unpacking all of this for us. And then we will have some Q&A at the end, and then we will wrap up hopefully right on 1 o'clock for you all. As always, again, one CPD point is available to add to your log as part of the session. So if you're part of that program, please register and use that. And as always, questions. We love questions. This is meant to be interactive. So by all means, if there's something you need to know or something you're unsure of, or you would like to ask Tyler as he's working his way through all of the data, please drop those questions in the chat and we will get to as many of those we can at the end, and then come back to you if we can't answer any as well. So looking at our first poll question, so what impact do you expect the accommodation pricing review package to have on your FY27 revenue position? So it was pretty split across here. So 37% think that there's going to be a moderate positive impact. We expect to recover some upside with focused work. Then 29% were broadly neutral. The package largely passes us by without action. Then we had 24% that think there's negative or unclear. We are worried and will be worse off, or we can't see it yet with these changes. And then lastly, 11%, there's a significant positive impact. We expect to be a meaningful beneficiary. So still very, very much split across all of those responses that we've had. Next up, our question was, since the review was released on the 22nd of April, how has your organisation responded? And again, fairly well split here across all the groups. Leading it was, though, 39%. We're still modelling. It's on the agenda, but no decisions made yet, which is obviously understandable with everything that's always going on in aged care. Next was 27% with we're holding our current strategy and watching how the sector responds. So might get some good insights today from Tyler. 14%, or so 20%, we've already started our restructuring and accommodation pricing strategy. So if you are watching today, please drop your questions in the chat or let us know what you've been doing. And then 14%, we've reviewed the package and identified actions, but haven't yet implemented anything. Then, which lever from the review is most relevant to your FY27 strategy? So again, strongly, pretty much half of the responses here, we're still working out which lever matters most for us with 48%. And then coming in solid behind in second, RAD and DAP pricing freedoms, MPIR decoupling, conversion rates and price caps at 34%. And then a bit lower down, supported resident loadings and the 3-year ratio commitment at 12%. And 6% were said capital subsidies, interest-free loans, new home payment, significant improvement payment as well. And then lastly, how confident are you that your current accommodation pricing reflects the post-review settings? So again, pretty strong here, 50% are somewhat confident. We have a view, but it needs some validation. And then at 28%, not very confident. We know it needs work. 13% indicated not at all confident. We haven't started or don't know where to start. So again, hopefully we'll get some insights today. And at 9%, very confident. We've already stress tested and adjusted. So we love to see those confident providers that are all over things and on top of it. So again, if you are joining us today, please feel free to drop into the chat some of the things that you've done and started to look at already. So I'm going to hand over now to our head of data and insights, who's going to drive this today and take us all the way through the numbers and what we're seeing. So Tyler, please educate us all and take us through the numbers.
Yeah, thanks, Ben. The poll results there are very split. Not really any sort of significant trend one way or the other, but yeah, hopefully that means what I have to share will be valuable, give some guidance. Yeah, good afternoon, everyone, and welcome. Thank you for joining us. Today, we're looking at accommodation revenue and admissions management, and at why the margin sitting inside that part of your business increasingly funds your future. Um, I've broken it up into some segments for what we're going to cover over the next 55 minutes. And so here's where we're heading. We start with the funding backdrop, where the ANAC price is likely to land on the 1st of October and the realignment that's going to be happening underneath it. Then we'll look at why accommodation revenue matters, drawing on the profitability picture and the margin gap between care and non-care. From there, we're going to model the changes of the new accommodation supplement structure, the supported resident ratios, and the RAD-DAP economics. When then turn to balancing cash flow and capital, which is really about liquidity under the new act and investing in the demand that's coming. And we'll close with some practical moves from operators across the sector. So what we've heard people saying that they're doing or planning for. Um, so we'll start with the question every provider is asking this time of year. Where will the ANAC price land, and what does it mean for the subsidy that we actually receive? IHACPA hasn't released the pricing advice yet, but the inputs are clear enough now to model with some confidence. Our expectation is a price increase of between 3.5% and 4.5%. That would lift the base price from its current value of $295.64 to somewhere around the $306 to $309 per NWOW. And the case for that rests on what we've seen before and really the documentation and the transparency that IHACPA provide and operate under. And the ANAC price has risen historically almost entirely on the back of wage decisions. And the wage pipeline this year is substantial. The Fair Work Commission handed down its annual wage review, lifting modern award wages by 4.75%. And we have a further aged care work value increase for nurses taking effect in August. And with direct care making up roughly two-thirds of cost, those rises are very difficult to absorb in anything under a 4% lift. And what kind of holds us down below the top of the range is the cost collection. And so that data has placed the current price modestly above the costing result, which gives us, well, it gives the regulator a small buffer. And remember that IHACPA prices to efficient cost, not to that raw wage growth. And one important caveat, again, these are our estimates, not published figures. IHACPA advice should land in the next few weeks, and then we'll hopefully get some government confirmation in August. So we'll have at least a month plus to model the impacts. And the value of modeling it now, based on, a roughly 4% increase, is that you'll know where you stand before the numbers are locked in. And again, where this modeling can take on a bit more complexity, and a part that kind of matters more than that headline indexation is the latest cost analysis revealed misalignment between current ANAC funding and the actual cost of delivering care. That misalignment shows up in a couple of places, in the resident classifications and in the modified Monash regions or the base care tariff. So in the classifications, not every class is funded in proportion to what it actually costs to care for that cohort. And where funding sits above the cost of care, as it does for classes 1 and 3, there is room for the weighting to be trimmed, where the cost of delivering care consumes a higher share of the subsidy, as we see here for classes 2, 10, and 12. An uplift there is more likely. So we expect another round of adjustments to the weightings that sit beneath the price. And then moving to the base care tariff, the modified Monash zones in the cost collection data, it showed less than 10% variation in the average daily costs between MM1 and up to MM5. And that is a far narrower spread than the current funding differentials imply. And by contrast, the MM6 and 7 sit significantly higher than every other category. So the likely consequence here is a tightening of that base care tariff for the MM2 through 5. Um, and so you put those two together, and the message is pretty clear that the 3.5 to 4.5% increase is not going to translate evenly, meaning you have two homes receiving the same 4% indexation, and it is going to land very different once those class weightings and base care tariff changes flow through. And that gap between the headline indexation and your net funding needs analysis of your own claim profile to really understand. Um, if the care subsidy is being priced at efficient cost, then the surplus that funds quality reinvestment and growth has to come from somewhere else. And that's sort of the launch to the meat of this webinar is looking at, where does that come from? Where do we get any sort of surplus to fund that reinvestment? And let's start by taking an average daily subsidy. And this model looks at an average daily subsidy of $294. And we use that because it equates to a case mix of 215 care minutes and 45 of that coming from registered nurse. And once you account for reasonable staffing costs, other clinical needs, consumables, and administration, there's almost nothing left over. On our modeling, that surplus is about $16 a day. So that's roughly 6%. And that assumes you are delivering exactly 100% of your care minute target, no more and no less. And so now if we look at accommodation, and what we've modeled on here is a $480,000 room. And that same resident can generate a surplus closer to $40 a day, and that's around 24%, or roughly 4 times the margin that care subsidy can return. The strategic implication is the important bit. Understanding on care delivery, or sorry, underspending on care delivery is no longer a viable option because it means you're missing out on the care minute supplement and you're attracting an increased scrutiny from the Quality and Safety Commission. The best you can do with care subsidy is break even, and any wrinkle erodes that quickly. So that is exactly why the operational surplus increasingly has to come from accommodation. And here's a more granular view of that. So we're looking at the two cost centers here laid out side by side, modeled on those values we saw before, and in a per resident per day. And on the left, we see care and subsidy revenue of $294 against direct care staffing costs of around $205. The clinical staff, other clinical staff, $33, and consumables and administration of $39. That totals roughly $278 of cost, leaving that $16 of surplus we just discussed. And now on the right, accommodation. The revenue and recovery picture is built from the RAD return and the DAP and the basic daily fee, and then costs primarily coming from the catering, depreciation and maintenance, and cleaning, laundry, and utilities. The cost stack here comes out to about $125, and the available surplus is the $40 that we saw. And I want to stress this is not about chasing profit. Even if you are only trying to recover your costs, there still has to be a consideration for depreciation and refurbishment and for the investment needed to grow capacity. Organizations have to show some surplus to entice that investment and to assure lenders they can repay debt. You, your own values will differ from this model, but the shape of the problem holds. The reason this is suddenly so live is that demand has shifted the dynamic. Sector occupancy has recently tipped over 93% for the first time in 9 years. And after more than 6 years of occupancy decline, the number of residents has caught up to available supply, and demand is now driving the economics of resident contributions. That change in backdrop showed up immediately in pricing behavior. When the maximum room price without prior approval jumped from 550,000 to 750,000 last year, we have seen virtually every service in the sector increase their pricing over the past 18 months. And we look at the average room price across the sector, and that has stepped up noticeably month on month. And what providers are telling us, and again, almost every provider has put their pricing up, and they're finding that that price change is not affecting their sales processes at all. Consumers are largely accepting of the new price points. There is an important caveat on that acceptance. A major factor is providers being clear about the value in their offering. It is still very possible to overprice a room if you don't take into account your market segment, your target consumer, and your product positioning. The price point has to be backed by data. One of the bigger variables sitting underneath room pricing is home ownership and median house price. Older Australians have traditionally had high rates of home ownership, and that has often been the key financial asset they bring to retirement. And when you compare the growth in median house prices against growth in the price of a single room with a private ensuite, which is by far the predominant product across the sector, room prices have lagged. And as you can see here, the relationship varies from one capital city to another, and it becomes more pronounced as you drill into specific regions. And as Uniting put it in one of our panels recently, the ballooning median house price means many people are coming with significant liquid capital, which has supported double-digit price growth with very little pushback. As the median house price use the median house price as a really localized input among many other contributing factors. And it demonstrates the need to review rather than telling you what to do. The accommodation pricing review and the government response have given us real detail to work with. And so now we're going to move into some modeling um, around what is changing and what it means for your strategy. From the 20th of March next year, and subject to indexation, but the accommodation supplement is being restructured. And you can see the current rates against the new rates here. And there are three structural shifts worth holding on to. First, the new middle tier of the higher accommodation supplement at $66, which cushions homes that fall just short of the 40% supported resident ratio. And that removes a sharp cliff that existed before. And second, the three lowest tiers are removed, with the base supplement now set to $52. And that's because the review found that those lowest rates were insufficient to cover the cost of accommodation. And then third, there is a new $20 per day top up for homes with a supported resident ratio of 60% or higher. And a few practical notes on that top up. You don't need to apply for it. It's paid as part of your monthly claim, the way the 40% threshold is, and it's based on your monthly supported resident ratio. And it's the same whether you receive the base supplement or the higher supplement. And it doesn't affect the means testing of resident. However, it has been tagged with an end date. So this one is due to expire at the end of June 2036. Once you put those loadings together, the supported resident ratio becomes a genuine strategic lever rather than sort of anecdotal according to your admissions and departures. And you look at the maximum funding available in a new home with a supported resident ratio of 60% or higher. The maximum higher accommodation supplement of $77 plus the $20 higher supported ratio top up plus the new $30 new home payment. And that stacks up to as much as $127 per supported resident per day. So the new capital subsidies sit alongside this. The new home payment of $30 per supported resident per day for up to 25 years, running up to the end of 2051, and a significant expansion payment of $15 per day for homes that increase their bed numbers by at least 40%. The accommodation supplement loadings really reward providers who are deliberately specializing in supported residents. But there is a commitment attached. The review asks existing homes to maintain their supported resident ratio within 5 percentage points of their FY25 levels for 3 years. So the position you take now sets that boundary on what comes next, which is really why you want to model your ratio honestly rather than optimistically. The review also changes the economics of how residents pay. And on what's changing, the maximum permissible interest rate is being decoupled from the RAD to DAP relationship. Providers will now gain that ability to set their own conversion rates. The 4 year also the 4 year reapproval cycle for higher priced rooms is removed, and the price cap framework shifts to a DAP basis. And a 2% RAD retention applies from the change of each financial year. And what that means for you is that the conversion rate freedom changes the relative economics of taking a RAD versus a DAP. And it gives confident operators pricing flexibility that they didn't have before. RAD capital remains the cheapest source of funds for building and refurbishment, but balances have been artificially constrained both by the legacy cap and by the really genuinely remarkable increase in the cost of land and construction over the last few years. The bigger strategic point, excuse me, we have several providers who have raised this with us, and that is um, to plan now for a future in which RADs may need to be refunded without being replaced like for like. And nobody thinks that transition is going to be easy. And I don't think anybody really thinks that it's imminent. But positioning your portfolio for that is really sensible. And this chart, we're looking at our higher everyday living analysis, and it captures a clear signal. As room prices, as the bands rise in room prices, the resident contribution towards hotel type services rises with it, and it rises faster than the cost of providing those services. So resident contribution climbed from about $84 a day in homes priced under 400,000 to over $133 a day in homes priced above 750,000. Meanwhile, expenditure on catering, cleaning, and maintenance rises far more slowly across those same bands. So the surplus available to fund quality grows as you move up those price points. And the way providers capture that gap deliberately rather than by accident is with higher everyday living. And they offer that it is designed to uphold even if consumers opt out. So the revenue opportunity is real. The constraint for most providers is not whether to invest, but whether they can. And so let's talk about cash flow and capital. Demand. So we'll start with why investment is unavoidable. The demographic forecasts are about as confident as forecasts get because the people are already born. The over 85 population adds more than 150,000 people by 2030, an increase of around 26%. And this is not the distant future. This is in the next few years. And even on the assumption that home care uptake increases and reduces the residential share, the overall number of residents in residential care will still rise. And on the modeling shown here, that number almost certainly takes us beyond currently available capacity. So the sector has to grow. That means refurbishment, which is often what allows you to lift prices in the first place. And it means genuine greenfield expansion. And the question then quickly becomes how do we fund it? And here is the elephant in the room, which is access to capital. The new financial and prudential standards under the new act lift liquidity requirements materially. And best estimates put that in the range of a 70% increase in required liquidity, which is not insignificant. Liquidity is already highly variable across organizations. Some are very comfortable and able to commence all of the works and acquisitions they want. Most need careful planning, and some have already moved into a highly leveraged position. The new reporting requirements will give far more visibility over this and will ultimately steer a legislated path that reduces reliance on RADs without collapsing a business that is servicing significant debt. Three considerations follow from that. So plan around the RAD transition deliberately. Recognize that larger providers can lean on the law of large numbers to manage RAD inflows and outflows in a way that a single site provider simply can't. Um, and accept that the pricing cycle is shortening. And so when you're reviewing prices, historically, very infrequently to potentially now annually and moving really towards quarterly. And so that $750,000 cap that's being indexed, it is a clear signal that we need to start shortening that pricing cycle. So the ability to pivot faster is becoming a capital planning advantage in its own right. So this brings me to probably the single most important message of this section. And That is, many providers need to lift accommodation revenue, but they need to also desperately need to refurbish to do that. And the sector needs greenfield expansion on top of all of that. Now is the time to put that capital to work. Invest in your business to improve revenue, extend asset life, and expand capacity because access to capital is only going to get harder the longer you wait. Dramatic pause. And so what providers are doing, that's our view of the numbers, what we just went through. The more valuable perspective is what operators are actually doing about it. So let's look at moves from across the sector. A few themes have come through strongly from the providers we work with. Vasi RSL Care makes the point that you should get the clinical base right first. And there's not much point or value opening another non-care revenue path until your care minutes and ANAC funding are optimized. And they now treat RAD reviews as an ongoing data-driven process rather than a one-off. Respect, they have grown from 7 homes to 27, and they have leaned into sales discipline. They're investing in a CRM and training and people from sales backgrounds. They run different pricing strategies tuned to each region and supported by competitor research and even mystery shopping. Regent's Garden, so they run consistently around 99% occupancy across their 515 beds. And with additional services ending, they are focused on what residents actually want and will pay for under the new framework while managing the real administrative burden of that opting in and opting out. And then Uniting, so obviously at really significant scale, they are describing how they're running out of occupancy headroom and pivoting from chasing volume to maximizing yield. They are investing heavily in analytics, competitor and demographic scanning, and building to the customer rather than putting something out into the market and hoping it matches. So, what should boards and executives do now? There, uh, there's three actions that are really genuinely time sensitive. First, stress test your accommodation pricing against the post-review settings. If your room prices were anchored to the old 550, fi- sorry, 550 thousand threshold, that you're really likely leaving revenue on the table, and less so, but still relevant if it's anchored to the new $750,000 threshold. That quarterly indexation really needs to be an indicator for you to also review that pricing quarterly and align it to what you're seeing in your own catchment areas. And potentially, if you haven't formally reviewed pricing at all in the last 12 months, then yeah, you're almost certainly leaving revenue on the table. Second, model your supported resident ratio. The new loadings, so the 60% top up and the proportional interest-free loan scheme, all reward providers who know their position and have a plan. And remember that there is a 3-year lock-in commitment that sets your boundary. So the number you choose now really matters. And third, treat capital decisions as reversible only until they're not. And what I mean by that is, so if you have land sales, exits, any major refurbishments, that were evaluated under the old regime, they really need to be retested. And a regional rebuild or a memory support upgrade, they can look fundamentally different under these new packages. And so this is precisely the work we do with providers. And it's why funding and care minute management now demand robust systems rather than spreadsheets. Mirus metrics connects funding, care minutes, and roster data so you can see what each scenario means before it happens, class by class, home by home, region by region. This is what lets you stress test your portfolio against a 3.5 to 4.5% price rise scenario and against the class and region changes underneath it. And paired with Care Minute Manager, it turns those assumptions into an operational plan. You manage your claims to a target from the first day of the quarter, dialing up and down for resident movements and roster changes. And that protects that small care surplus where, any wrinkle erodes. Put simply, those two together is about the right people in the right place delivering the care minutes your funding depends on. But also the capital insights that sits within Mirus metrics as well. So the board level capital strategy, your RAD DAP pricing, occupancy and property economics, all in one defensible view. And so, really, to bring it together, the headline ANAC increase is only half the story, and the realignment underneath it, so that recalibration of RVUs and NWOWs and base care tariffs, that it really means that that same percentage, that same indexation, is not going to reach every provider equally. Care subsidy, ultimately, no matter where it lands, is going to be a break-even proposition. So accommodation and care revenue increasingly carry the surplus that funds quality and growth. The accommodation supplement changes, and the new capital subsidies reward providers who manage their supported resident ratio and their pricing very deliberately. And all of that has to be balanced against tighter liquidity and the demand that is coming. And so if you want to stress test your own portfolio against these scenarios, we'd be glad to talk through it with you. And I hope that there has been some good conversation in the chat, and we can keep the conversation going.
Thanks, Tyler. No, chat is quiet today, but I have a number of things to throw at you. Thank you for unpacking that. You always do such a fantastic job of making it a lot easier for the everyday person who may not be diving into all these numbers on a daily basis. So some of the things just to clarify with you is how should homes be managing those supported resident ratios now on a daily basis, and obviously the movement of their residents coming, and how do you decide on obviously those tierings now and the additional payments that go with those?
Yeah, so under the new settings, that supported resident ratio becomes even more of a strategic lever. So the new 60% or higher supplement, you stack that accommodation supplement to the higher payment. So you have essentially the three payments, the accommodation supplement, the 60% higher supported ratio top up, and the $30 new home payment. And so it's really worth looking at all of the scenarios that are available, because in some situations that package deliberately rewards providers for choosing a specialization. So if you want to have 70, 80, 90% supported or concessional residents, versus, zero, or 10, 15, whatever. And one of the other things to consider there is that there is no minimum supported resident ratio. And this is, I guess over a year on now from that decision being made, but not really widely um, published by the department. So there was, and even when it was in effect, it wasn't, I think, governed that broadly. But there was for each aged care planning region a minimum supported resident ratio. Um, and that could have been anywhere between 10% to up to 22%, but that's been totally removed, so there is no minimums anymore, and uh, that again, I'm just highlighting that because it's something I still get questions from providers about, because
And
it just wasn't something that was really well understood or well broadcast. But the right number, so there's no universal answer for what is the exact right ratio of concessional residents, because it really depends on your location, and your asset. And for almost every provider in the industry, it really matters on your mission that you're trying to fulfill within the community. And for multi-site providers, it usually takes on a lens of leveraging that portfolio in different ways, where you can have each home within the organization fulfilling different aspects of an organizational strategy around bringing in capital versus bringing in cash flow, versus fulfilling a community mission.
yeah, thank you. Now we have got some chat. That's obviously stirred a few people up. So the first question I've got here, and I was interested in this one too. So please explain the comment that RADs and MPIR have been delinked.
Right. Well, so this was a finding from the review, and it was actually something that Rob Cavino and myself highlighted to them when we had a chance to sit down with them and discuss the nature of the MPIR and RAD and DAP pricing. And it really goes to the foundation of that liquidity across the sector, where we have just a hugely variable liquidity from one provider to another, where providers that have significantly invested in greenfield, um, new expansion and adding homes to the sector, um, they have put themselves in very highly leveraged positions. And some providers that model that investment into building new homes, they do so with an assumption that they are going to bring in lump sum RAD payments. And so if they find that their consumer base are really attracted to, DAP payments. So, a brand new home, even if they're putting a very high valuation on each room, we still see a lot of consumers still willing to pay that daily equivalent, even at a very high MPIR. And where that can really unwind some of that modeling is where they're servicing debt that is above uh, the MPIR. And in that instance, the provider really needs to use that as the maximum interest rate or the daily equivalent calculation, because that's what they're servicing. And so they, I guess, shouldn't be disadvantaged by rules that dictate how they are allowed to price their rooms. And so freeing up that MPIR just means that that variance in liquidity between providers doesn't advantage one over the under other. So those, very highly liquid organizations that have the massive war chest that can do whatever acquisition project they want or whatever new build. Um, this really sort of levels that playing field, if that makes sense.
Okay, thank you. Next question. Got a lot of questions now. Has the proposed interest-free loans been confirmed? They thought it was under consideration with the details and fine print to be determined, and they thought it was only applied on completion of new constructions.
That one I'll have to take under advisement and come back.
Come back.
I don't know if it's 100% or still up for discussion. I assume if it's not a sort of a broad offering, it would likely revert to a grant application process.
Okay, no worries. We'll take that one on notice and come back. Next question was, someone's understanding was that the 60% supported ratio supplement was from March of 2028, not 27. They are at that level now with one facility. However, carrying this for another almost 2 years is a significant financial burden, waiting for the new supplement. Do you have confirmation on the 60%?
Everything I've read points to March next year.
Okay, fantastic. Um, can you confirm whether the approval of room prices by IHACPA is still a proposal or whether this has been agreed to by Doha?
Yeah, so all of this, I guess, is this one person asking all these questions?
No, no, these are several people. These are several people.
Yeah, so there was the accommodation pricing review, and they gave their uh, recommendations or their findings, and then the department gave a response, which is not legislation. And so there is a bit of sort of reading between the lines, I suppose, but ultimately, um, this is the information that we have to go on, and so whether it changes in the future or not, or lands as law, we'll have to wait and see. But ultimately, what we know based on history is that when the Commonwealth replies to a report like that with their response, those response items will typically matriculate into legislation.
Another question, different person again. So our supported resident ratio is calculated after the extra service beds. With the removal of extra service beds from November this year, the supported ratio will decline. Is there a strategy we can implement to manage and mitigate this impact?
To regain concessional residence.
I'm not sure. So the supported resident ratio is calculated after excluding their extra service beds, obviously. So
Oh,
probably
yeah.
maintaining their supported resident ratio at the higher level with the loss of those.
Yeah. Okay. Yeah. So yeah, with the winding up of extra service rooms, I I don't think that should actually affect your supported resident ratio because when you have extra service places, you wouldn't have a supported resident in an extra service place, and extra service places are going to be removed from the numerator and the denominator of the ratio. So by removing extra services from a service, it shouldn't affect the outcome of your
So
supported resident ratio.
maybe it's a more of a health question then potentially to pivot to a high everyday living component instead of the extra services that they may be offering.
Right. Yeah. Yeah, I might have to think about that one a bit more, but I removing extra services, I don't think would have a material effect on the payment. So meeting a concessional ratio. So yeah, I might have to put some more thought to that. But yeah, I guess the extra services in general is such a small segment of the industry now. It's a very niche question, but yeah, happy to work
Yes.
that through.
Yeah, and someone's just dropped in as well to the chat now that so extra service beds used to be excluded from the denominator. It's all getting outside of my knowledge of extra service calculations and funding.
Yeah, so I guess if you have an extra service home, are you also close to 60% concessional? That's a question to the person asking the question.
All right, I'll see if there's a response. So a couple of other questions. I've got some as well, just to see what your thoughts are. So obviously, this is the government's sort of initial response. You see, what are you sort of watching for any other future announcements as we sort of progress? Obviously, with those numbers you were talking around, as well with the aging population. If you put your crystal ball to action.
Yeah, so I think it it is going to require walking a tightrope with how we attract investment. It is going to be very clear that we're going to run out of capacity, and we cannot simultaneously remove the reliance on RADs while also attracting the appropriate level of investment into the sector. And there has to be some thinking done there with regards to how we achieve that, because again, that variability and liquidity where we have highly leveraged organizations versus others that have their war chests, where we can't have that monopoly in the industry. We have to have the capacity for free market and people to enter the sector. And yeah, there will need to be decisions made sooner rather than later. But the shape that those take, I really couldn't say.
Yeah. And then I also really liked I guess the moves from you had from across the sector, that slide as well, where you highlighted some real world cases and scenarios of what some providers are actively doing now as well, which is really quite relevant, I think, isn't it? When you look at sort of the ANAC and the care minutes and the optimization and what people look at nowadays, especially with the VASI example here, is traditionally a lot of providers have always just gone, submit, 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 ramp up the cost, and it's a bit more of a balancing act now as well with those claims and the classes and your care minute obligations.
Yeah, one. So I think, yeah, a few things with regards to looking at what legislation is likely to come out. One of the things that I am fairly confident on is that the level of subsidy that the Commonwealth is prepared to contribute to any given resident is going to align very closely to the level or amount of care, the quantum of care, I should say, that you're going to be required to demonstrate. And so that margin that's available between care subsidy and the cost of care is always going to be very, very tight. And actually, the other thing, I guess, going to, forecasting what um, changes might be coming. Where is it? Where's my this one? The cost collection that IHACPA did show some really interesting gaps. And history has also shown that when they identify discrepancies between classifications or between anything that they have sort of a lever to correct, they will do it. And so the relative value units that determine the number of minutes required for any given classification and the National Weighted Activity Unit that determines the daily subsidy for each classification. Those are levers that they have shown they're not going to hesitate to adjust those. And so the transparency of all of that documentation around their pricing guidance, but also the that cost collection is to me a really clear indicator that the underlying framework of the ANAC pricing mechanism is up for some real significant recalibration. And so again, there will be an indexation to the price, so that national efficient price that then feeds through that ANAC mechanism is going to increase. And depending on how much they want to tinker with those underlying weightings may dictate the headline price indexation more significantly. But when we look at the the Fair Work decisions and just general consumer price indexation, the new figure for October, is going to be, somewhere close to 4%, whether it's 3.5, 4.5, maybe 5. If it wanders too far away from that, it's because what they did underneath was significant. And so I think there is the potential for a really significant restructuring where, obviously they can't come in with a whole new pricing tool or funding tool, I should say, sorry. But what they have available within the current ANAC tool provides quite a lot of adjustments to be made.
Fantastic. Thank you. That's our questions for today. Let's move on to we'll wrap it up, the session for today. So as always, for people who aren't aware, we do also provide accommodation pricing reports, which are really, really valuable, provide some fantastic insights. So there is a QR code there. You can also find it on our website as well. So these reports are tailored to your organization. They give you the insights and breakdown of the room prices and competitors around you as well. If you have not seen those before, please reach out to us. And then next month, our July webinar, we are going to be doing on quality indicators briefing. So basically looking at all the essential data, what's come out, and actually a bit of a new model for us. We're going to do just a small little 30-minute bite size on all the data that's just come out recently. So please register for that. We will be sending that out. That will come out through our Mirus mail. So please join us for that webinar in July. And also, we're always interested to have providers come on and join us, explain and talk about their experiences, what they're doing. So if you are interested in joining any of these webinars and providing some information from on the ground of what you're dealing with and how you're managing things across any of these topics, by all means, please reach out to us. We'd love to have you on our panel. And that's it for our day today. So thank you again. Hopefully this was all insightful. And if you've got any comments or questions, please reach out to Tyler. I'm sure he'll be happy to help. And this webinar has been recorded, so you'll be able to get a copy of the recording as well to share amongst your colleagues. Thank you again, everyone, and have a good day.
Bye-bye.